Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Mitigating Counterparty Risk, Strategies for Smart Investors. Understanding Counterparty Risk, a guide for investors. Ever wonder who's got your back in financial trades? That's where counterparty risk comes in. It's all about the trustworthiness of the other party in any transaction. If they don't stick to their end, you're the one facing potential losses. As the financial markets get more connected and complex, understanding this risk is not just smart, it's essential. With recent upheavals reminding us of the stakes, knowing how to manage counterparty risk can save you a lot of headaches and money. Whether you're trading stocks or signing a new contract, grasping this concept could be the key to safeguarding your investments. Defining counterparty risk. Counterparty risk is at the heart of any financial transaction. It's the potential that the person or institution on the other side of a deal doesn't hold up their end of the bargain. Picture it as the risk that your partner in this financial dance might slip, causing you both to stumble. In simple terms, if they fail to make payments or deliver the expected assets, you could face financial loss. Understanding this risk is crucial because it affects everything from simple trades to complex derivatives in the financial markets. Types of counterparty risk. Counterparty risk isn't a one-size-fits-all issue. It comes in different flavors, each with its own challenges. Credit risk. This is perhaps the most talked about form. It's the risk that your counterparty will default on their financial obligations. If they're unable to pay back a loan or fulfill a contract, you're left in a bind. Settlement risk. Often overlooked, this risk arises during the exchange of assets. It's the fear that one party might fulfill their obligation while the other fails to, leaving the former empty-handed. Operational risk. This is a bit sneakier. It involves potential failures in internal processes or systems that might prevent a counterparty from delivering on their promises. Think of it as the risk of a glitch in their operational machinery. Each type brings its own set of risks and rewards, and understanding these nuances helps in planning better strategies. Importance of monitoring counterparty risk. Why should you care about monitoring counterparty risk? It's simple, the stakes are high. Financial institutions and investors alike must keep a close eye on this risk to protect their portfolios and maintain stability. Imagine driving a car without checking the rearview mirror or blind spots. In finance, that's akin to ignoring counterparty risk. Here's why monitoring this risk matters. Protection against loss. Keeping tabs on counterparty risk is like having a trusty seatbelt. It offers a layer of security in turbulent times. No one wants to be caught off guard by a default that could have been anticipated. Maintaining trust. In financial markets, trust builds the bridge between parties. Monitoring ensures that trust is not misplaced and agreements are honored. Regulatory compliance. Institutions often have legal obligations to manage and disclose counterparty risks. Staying compliant with regulations is crucial to operating smoothly. Market stability. Effective monitoring helps in maintaining overall market stability. Less risk taken by individual entities translates to less systemic risk across financial systems. By understanding and managing counterparty risk, institutions pave the way for safer, more reliable trades and investments. Sources of counterparty risk. Counterparty risk might seem straightforward at first glance, but several factors make it a complex issue. Understanding where this risk comes from will help you manage it effectively. Market conditions. Market conditions shape the landscape of counterparty risk. Picture this. When markets are calm, sailing your financial ship is fairly straightforward. But when waves of volatility hit, even the most reliable counterparties can wobble. Economic shifts, like a sudden recession or a spike in inflation, can turn trusted partners into risky bets overnight. Volatility can trigger defaults, and in uncertain times, companies may struggle to honor their obligations. An investor must stay alert and adapt strategies to ride out these stormy conditions. Relationship dynamics. The dynamics between counterparties play a critical role in risk exposure. Think about it like a dance partnership. If one partner is out of step, the whole performance falters. The nature and history of the relationship matter. Are your partners transparent, with open communication channels, or do they leave you guessing? Have they shown reliability in past dealings, or are there red flags? Long-term, stable connections typically imply lower risk, whereas new or strained relationships might require a closer watch. It's crucial to assess the trust and transparency between parties to gauge the potential risk accurately. Regulatory environment. The regulatory environment acts as the referee in many financial transactions. Regulations set the rules for managing counterparty risk and maintain market integrity. They dictate how companies disclose their risk exposure and enforce standards that influence risk management strategies. In a way, they provide the playbook for navigating counterparty interactions safely. However, regulatory changes can also introduce new risks. Staying updated with the latest legal requirements and compliance expectations is paramount. Understanding the regulations at play allows you to adjust your tactics, ensuring you remain compliant while minimizing risk. By analyzing these sources, you can better manage counterparty risk, making informed decisions to protect your financial interests. Assessing counterparty risk. Understanding how to assess counterparty risk is vital. This risk assessment helps ensure that you're not left holding the bag when your financial partner fails to follow through. It's crucial to adopt a strategic approach to evaluation. Credit ratings. Credit ratings act as a financial report card for companies. They provide a snapshot of a counterparty's creditworthiness. But how do they work in assessing counterparty risk? Third-party evaluations. Credit agencies like Moody's or Standard & Poor's analyze financial health. They evaluate factors like revenue streams, debt levels, and payment history to assign a rating. Rating scale. These ratings often range from AAA, excellent credit standing, to D, in default. Knowing the scale helps you gauge the risk. Higher ratings mean lower risk of default. Risk signals. A sudden downgrade in a counterparty's credit rating can be a red flag. It might indicate financial trouble ahead, prompting a reevaluation of your dealings. Credit ratings simplify the complex task of evaluating a counterparty's financial stability. They offer clear indicators to decide whether to proceed, hold, or reassess a partnership. Risk metrics and models. Risk metrics and models offer another angle to assess counterparty risk. These tools quantify risk, providing a clearer view of what you might face. Value at risk, VAR. VAR calculates the potential loss in value of an asset or portfolio. It provides a probability of loss over a defined timeframe. This metric helps in understanding financial exposure under normal market conditions. Stress testing. Think of stress tests as a way to see how your financial relationships hold up under pressure. They simulate extreme scenarios like economic downturns to measure resilience. Credit default swaps, CDs. A CDs is a financial swap that measures the risk of default. The price of a CDs can indicate the market's perception of a counterparty's credit risk. These metrics and models can be seen as a toolkit for financial due diligence. They provide insights beyond what credit ratings alone can offer and can help in making informed risk management decisions. Mitigating counterparty risk. Handling counterparty risk can make or break financial stability. It's more than just a financial buzzword, it's about securing the financial future by ensuring that your trading partners are solid. Let's explore some strategies that can help manage and mitigate this risk effectively. Diversification. Diversification is like spreading seeds in a garden. You wouldn't want all your roses in one basket. If a late frost hits, you'd lose them all. In financial terms, diversification involves spreading transactions across multiple counterparties. This reduces reliance on any single entity, thus minimizing exposure to potential default risks. By not putting all your eggs in one basket, you guard against the failure of one particular counterparty affecting your entire portfolio. Here's how diversification helps. Multiple partners. Work with a range of counterparties. Different sectors and markets have varied risk levels. Diversification spreads out that risk. Varied instruments. Engage in different types of transactions, stocks, bonds, derivatives. This way, you're not overly dependent on one financial instrument or market. Geographical spread. Diversify across regions. Economic conditions vary globally, so exposure to different markets can balance out economic surprises. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.